In today's video, we'll do a detailed review about one of the most talked about mid-cap fund, that is Quant mid-cap fund. Lately, quite a few content creators have been heavily criticizing Quant Fund House due to its exposure in Adani Group stocks. So in this video, we'll also talk about its effect on the fund's performance. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. So let's start the video with the basic details of this fund. Firstly, the AUM, that is total asset under management, which is about 1,500 crores, which I feel is not too high, not too low for a mid-cap category. While the expense ratio is 0.63%, which again is okay as compared to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is Nifty Midcap 150 TRI. Now let's look at the sector-wise allocation. From the graph, it is very clear that the fund is heavily invested in financial sector, followed by automobiles, consumer staples, and service sector. Generally, financial sector is considered as a core sector, whereas consumer staples and services are considered as evergreen sectors. As the mid-cap sector is quite large, the fund manager has better options to pick good stocks from this category, which we'll see in the next section. When this sector allocation is compared to its benchmark, the allocation is quite different. Here, one thing should be noted that allocation of financial sector is quite high, and such a high allocation to a particular sector can lead to concentration risk and can dampen the performance of the fund if this sector does not perform well. Now let's look at the top holdings and portfolio allocation. As evident, PSU bank stocks like Punjab National Bank, Union Bank of India, and Canara Bank are the main stocks of the financial sector, whereas ITC is from the consumer staples section. Escorts, Kuberta, and Bosch are from the automobile sector. These stocks are as of 31st of January 2023. The fund has a tendency of changing stocks very fast, which we'll see in the coming section. The portfolio is quite concentrated as there are only 30 stocks and the top 10 stocks for more than 50% of the portfolio, whereas top 3 sectors contribute to around 52% of the portfolio, with around 29% coming only from the financial sector. Now let's also check the portfolio allocation. Here if you observe, mid-cap stocks form around 56% of the portfolio, whereas the rest 44% is allocated to large-cap stocks. Surprisingly, there is no allocation to small-cap stocks. This type of portfolio allocation is considered conservative and less volatile, as there is no allocation to small-cap stocks. But on the contrary, quant schemes are considered more volatile and risky as compared to other schemes. Let's see in the later part of the video how volatile and risky this fund is. So before going to the risk parameters, let's see the stockholding trend for this fund. As evident from the table, the fund has a tendency to churn its portfolio very frequently. If you observe, in January 2023, they have added ITC, whereas they have reduced their stake in PSU banks like Union Bank and Canara Bank. Here, I would like to highlight one stock specifically. Yes, Adani Ports and SEZ. Here if you see, the fund had a holding of 4.12% in December 2022. But after the Hindenburg report, it has reduced its holding to 2.75% as of 31st January 2023. As per the reports, as of date, it does not have Adani Port stocks in its portfolio. This can be counter-checked when the stock portfolio of Quant Midcap Fund is published on 28th February 2023. We'll also try to cross-check this in the returns section also. Now let's look at the fund managers. Mr. Sanjeev Sharma has been managing this fund since October 2019, that is almost from the inception of the scheme. Here one thing should be noted that in mid-2018, Escort Fund House was acquired by Quant and all the schemes were renamed as Quant schemes. Mr. Sanjeev Sharma has been joined by Mr. Ankit Pandey in 2020 and by Mr. Vasav Saigal in April 2022. All these 3 fund managers have been managing not only this scheme but also other schemes like Quant Active Fund, Quant FlexiCap Fund, and Quant Small Cap Fund. Now let's see how the fund performs on risk parameters. Here we compare the parameters with the benchmark index and the category average. First one, mean returns, that is the average return in a year, which is 32.60, which is quite high than both the category average and the benchmark. Here, higher the value is better. Second one, standard deviation, that is a tool to measure how much the return has deviated away from the mean return, which in this case is 23.50 and is less than the category average, but more than the benchmark index. Here, lower the value is better. Third one, Sharpe ratio. That is a tool to measure the risk-adjusted return, which is 1.23, which is more than both the benchmark and the category. Here, higher the value is better. Fourth one, beta. That is the volatility of the scheme compared to the benchmark, which in this case is 0.83, which is less than the category average. Here, lower the value is better. Fifth one, alpha. That is a tool that measures how much better the fund has performed compared to its category. Here, it is 12.75, which is quite high than the category average. Here, higher the value is better. Here, on almost all risk parameters except the volatility, Quant Midcap Fund performs better than the benchmark and the category, which is a positive sign for a fund. Now let's compare the returns. Firstly, the trailing returns. On comparing the trailing returns for 5 years and less, it easily beats the benchmark and the category with a good margin across the entire period, which is quite commendable and a positive for a fund. Here we will ignore the returns of more than 5 years as the fund was acquired in mid-2018 from Escorts and the now team of fund managers have been managing the scheme since then only. Let's also check the returns for the period from 24th January 2023 till now. As evident in the graph, the fund's performance has been quite poor, and the main reason for this is its exposure to Adani stocks. And as per the report, it has been selling its Adani stocks during this period. Hope by now it would have sold all its holding, and hence now we can see a better performance in the coming times. Now let's also check the calendar returns for consistency of the performance. Leaving aside the year of 2019, when the fund has underperformed, the fund's performance in 2020, 2021 and 2022 has been better than both its benchmark and category. Especially in 2022, it has usually outperformed its category and benchmark. Hence, we can safely conclude that the fund is quite consistent in its performance. Now let's also check the rolling returns. On checking the rolling returns for the period of 5 years, it is able to beat its benchmark 56% of times, whereas for 3-year period, it is able to beat its benchmark 68% of times, and for 1-year period, it is 96% of times, which is quite good for a fund. Hence, it can be concluded the fund's performance is quite good. Now let's also see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 114, which indicates that the fund outperformed 14% more than the index during this rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 66, which indicates that the fund declined 66% as compared to the index during this fall. Here, lower the value is better. The upside ratio and downside ratio both are quite good, and it has been generally observed over long run that funds having a higher downside protection has been able to generate better returns. Here, as both the ratios are quite good, the fund has the potential to generate excellent performance in long run. Now let's see the risk return graph. Here on x-axis we have standard deviation, whereas on y-axis we have total returns. It is very evident from the graph that the fund has a better total returns value with a higher standard deviation as compared to the index, but less than that of the category, which indicates that the fund is able to generate better returns than both the category and index, but with a more volatility compared to its index, but lesser than its category. Generally, higher volatility is directly linked to higher risk, but if the investment horizon is longer, this does not always stand true. Hence, for a mid-cap fund, one should have a longer investment time horizon, typically 7 years and more. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched this video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel to watch such interesting videos in future also. So now let's look what investors should do. Firstly, the existing investors. As the fund's performance is good and is able to generate good returns, I feel there is no need for the existing investors to worry and continue their investment in this fund. The volatility of the fund should not be a concern as mid-cap segment is prone to higher volatility. Surely, the Hindenburg crisis has put a small dent in the returns of this fund, but with the proactive strategy of the fund, this effect should mitigate soon and we will be able to see excellent performance of this fund. This is my personal opinion and I may prove wrong in the coming period. What do you think? Please comment in the comment sections. If you still feel uncomfortable with the volatility of this scheme, you can go with less volatile schemes like PGIM or SBI mid-cap funds. I have done a detailed review of this fund. Link is attached in the I button and in the description. Secondly, the new investors. As the fund performance has been quite good in the last 3 years, one can start investment in this fund. The higher volatility of the fund should not be a concern if you are planning for a long-term investment, say 7 years and more. Still, if you are not comfortable with the volatility and the investment style of Quant Fund House, you can go with PGIM or SBI mid-cap funds. You can check my video on best mid-cap funds for 2023. Link is attached in the description. I would like to add that presently I have Quant small cap fund in my portfolio and not planning to exit this fund now. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you have not done till now and also press the like button. Do check my older videos. Click the attached cards to watch the video. Thank you.